There's about 10,000 of these crypto tokens. And then there's not just dozens, but maybe hundreds of service providers, broker-dealers. They might call themselves exchanges. I might call themselves other things. You might think of them as the casinos, wherein the investing public is looking for a better future. And because most of these tokens are securities, that means that the storefronts, if you wish, or the casinos, need to come into compliance with our time-tested laws.
I was SEC Chairman Gary Gensler discussing cryptocurrency with our Jen Schomburger, the collapse of FTX impacting digital currencies and exchanges around the world. So where are we headed here? Lynn Alden is the Lynn Alden Investment Strategy founder. Nice to see you. So let's talk about those comments there from Gensler. When he's likening it essentially to casinos, what does that say about the environment and about trust in crypto?
Well, I think what it generally shows is that a lot of these assets are securities, which essentially means that they raise capital, and you're relying on a group of others to try to develop that in a common enterprise, like an investment contract. And a lot of them have been launched, but didn't go through the normal securities process. And it's somewhat understandable because it's a new field. The technology makes it easier to launch these things. That's kind of the whole point. And so there's a conflict between the iteration of the industry and then bringing that in line with actual securities law. So right now there's this arbitrage, and then you can get away with more offshore. And so a lot of these things are just being built and being kind of put together in ways that would not be allowed for mostly good reasons in the traditional equity or traditional securities world.
And Lynn, you're invested in crypto. Just your broad takeaway of what has played out over the last several weeks, the collapse of FTX, and what this means for the future investment of crypto, with so many people, I think, arguably staying on the sidelines right now.
And I think that's understandable. I mean, the way I conceptualize it is I put Bitcoin and the rest of the crypto space in two very different buckets. And so, Bitcoin's been around for 13, 14 years, depending on where exactly you want to measure it from. It's even according to SEC Chair Gensler, it's not a security because it never raised capital. It doesn't pass the Howey test. It's essentially a digital commodity. That's one area. Then there are areas like stable coins that are also, I think, providing a lot of utility. Obviously, they have more, they're more like securities or more like, bank regulated products in many ways. And then aside from there, you have this kind of rapidly iterating area, some interesting projects, some interesting technology, but for the most part, there's a decoupling between the actual technology and the desire from the developers and the early investors to get fast exit liquidity, to basically put a token, to put a security-like asset on something that doesn't necessarily need it, or that could benefit from it, but is trying to go through a process around the securities laws. And so basically, investors don't get any sort of disclosures necessarily, and they don't get a lot of the protections that they normally get as what they would find in equities or bonds or other capital markets. And so it's understandable that large pools of capital would be very cautious, especially of that ex-Bitcoin crypto market. But of course, Bitcoin also gets lumped into it because it can be levered as part of this ecosystem. And it's also obviously very narrative tied to this ecosystem.
We just put up the price of Bitcoin. It's hovering around 17,260, down, but only down about 6% in the last month, when you would think it would have been devastated by this FTX collapse. Are you surprised?
Not really. I mean, I think this whole debacle was somewhat surprising. I mean, for example, I wrote months ago about the Luna collapse before it happened. I was very concerned about it, and I was very concerned about the impact it would have on Bitcoin. That played out. But admittedly, the sheer size of what happened over the past month or so was surprising even to me. But it's not that surprising that there's some degree of stability. If you look at various on-chain indicators, for example, there's been a huge burst in self-custody of Bitcoin, right? So a lot of enthusiasts are using this as a buying opportunity. They're using it as an opportunity to take it off exchanges, take it out of, if they're still allowed to withdraw from some of these custodians or centralized platforms, and bring it down to their own self-custody. There's also a very strong dollar cost averaging mindset in the space. And like I said before, there's kind of like two very different ecosystems. For example, the Pacific Bitcoin Conference was happening during the whole meltdown a month ago of FTX and Alameda. And, the enthusiasm there was pretty significant. They were actually using that as an example for why they're in Bitcoin and not the broader space. So there's kind of two Venn diagrams here, and there is some degree of overlap, but they're actually somewhat separate ecosystems, even though the price tends to be highly correlated over any sort of intermediate term.
So then let's put Bitcoin on one side. When you take a look at maybe some of the other cryptocurrencies that you say are much more riskier in terms of investment wise, when you try to calculate the potential contagion here from FTX collapse, how bad, or I guess how wide do you see this potentially getting?
I think that we have to keep an eye on Genesis. That's the obvious one that could still lead to further contagion. I think there's also a couple more offshore entities that I'd be concerned about, ones that have their own token, ones that have done a lot of marketing. So I'd be concerned about those. My expectation is the worst part is probably behind the ecosystem now. But I still think that the Genesis and a couple others are really worth watching to see if there's any more, fast liquidations. But even outside of that, I think, if you grind sideways for a long period of time, if you go a year in a choppy market, a lot of these more euphoric things can be down a lot more than something like Bitcoin or something with utility like stablecoin market cap or something like that. I think this is a chance for the industry to go back to basics and focus on solving real world problems rather than speculation, right? So if you look around the world, there's billions of people that have a savings problem and a payments problem. And that's what some of these technologies, I think, originally were just invented to solve. But naturally, people have kind of repurposed that towards speculation, leveraging offshore casinos, basically apps with no use case that have a token attached unnecessarily. I think that's the stuff that there's still a lot of malinvestment that has to kind of bleed out over a long period of time. And it might or might not happen with Bitcoin going to new lows. It can go sideways, it can chop along, it can go mildly upward, while some of the malinvestments can still bleed out over time.
All right, Lynn Alden, always great to get your perspective. Thanks so much for joining us here on Yahoo Finance.